Thank you all for joining us. Welcome to our forum on innovation in credit-sensitive rates, reference rates. As everyone here is aware, we've been encouraging market participants for several years to transition away from Libor to suitable alternative reference rates. And this is a transition, global Libor transition that is quite significant given the widespread use of Libor in so many trillions of contracts. From the Federal Reserve side and from our official partners, we're fully aware of the challenges and the importance of this global transition, and it's one of our top priorities at the Federal Reserve. As we do with all major policy initiatives of this sort, we've been holding discussions to understand the perspectives of all of those parties that are directly impacted by the Libor transition. And as I think this group is fully aware, some banks have highlighted their concerns around using SOFR, the ARC's recommended replacement for Libor, in commercial loans in the absence of a credit-sensitive spread. Given the importance of the commercial lending market and these concerns, the New York Fed hosted 4 credit sensitivity group workshops over the summer with banks and borrowers to better understand these challenges. These workshops, which we think were very productive, revealed that banks have different characteristics when selecting alternative reference rates to Libor based on their profile and business needs. It's also the case that we saw that the terms of commercial lending, including the selection of reference rates, are negotiated between banks and borrowers. And as a result, the official sector is not well positioned to adjudicate the selection of a reference rate between banks and their commercial customers. For this reason, following those 4 initial workshops, the official sector indicated that it did not plan to convene a group to recommend a specific credit-sensitive supplement or rate for use in commercial lending products. However, we do think that this challenge is an important one, and we are bringing together market participants for 2 additional working sessions to highlight the continued innovation in this space. And for today's working session, we've invited several presenters to discuss their work in relation to the data and design considerations for reference rates or a spread to SOFR, credit-sensitive spread to SOFR, that we talked about in some of our earlier workshops. The purpose of today's forum is really to advance some solutions for commercial loan products that the private sector can take into consideration and continue to move forward. Again, today's session is not intended to result in a recommendation of a credit-sensitive supplement or rate. As a quick reminder, the New York Fed team will be playing the role of timekeeper, and we want to make sure to keep today's session on track, and we want to get through each one of our presentations. It's very important that each one of the presenters have time to discuss their ideas surrounding this issue, and then also have an opportunity for the group to ask questions. But we might be a little bit more vigilant than normal in keeping everybody on track and reminding you when your time is up if you're a presenter, and closing out the conversations as needed. So that's a little bit of the background on today's session and what led us to these 2 additional workshops. I'd like to just quickly turn it over to Ray Check to cover some of the ground rules and the antitrust guidelines for today's session. So let me turn it over to Ray.
Thanks, Nate. Maybe we can move. Thank you. So just a couple of quick housekeeping items to touch on. As Nate said, today's forum is intended to provide market participants with information they can use to make their own decisions about reference rates. It's not an official endorsement or recommendation of any particular reference rate by any of the sponsoring agencies, and it's not expected to result in any such official endorsement. Any statements by representatives of any of the sponsoring agencies that are made today represent their own views and not necessarily the views of their agencies. So we can move to the next slide if you would. Because the forum is meant to make information available to market participants, today's session will be recorded, and the video and all the materials people are presenting will be put up on the New York Fed's website. So we'll just remind people, please don't say anything today that you don't want made public. The purpose of today's forum is not to reach any kind of collective view or agreement among participants about any particular rate or methodology or loan terms, and we'd ask participants to bear that in mind both during today's discussions and any comments you might make publicly afterwards. We can move to the next slide. You've all received a set of written participation guidelines in advance of today's session that includes some detailed antitrust guidelines as well that you've all agreed to observe. But I'll just remind folks that anytime competitors get together, which is in one sense what this gathering is, they need to be mindful that their conduct doesn't violate antitrust laws. The detailed antitrust guidelines that we sent around is intended to help you to do that, but it's the responsibility of each participant to make sure your conduct stays on the right side of the antitrust laws. Of course, you're free to consult your own counsel for assistance in that, but I would suggest that the most important thing to bear in mind today along those lines is, again, that the purpose of the forum isn't to reach any sort of collective agreement or view among participants of any kind. It's for the presenters to make information available so that each individual participant and folks watching after the fact can make their own decisions and ask their own questions as follow-ups. So with that, I would turn it over to Monica for some other notes before we start.
Maybe I'll just jump in quick before Monica. Thank you, Ray, for those updates. Maybe we could just switch to this slide with the participants for today. We won't do a roll call, but I did want to just call out the different firms and entities that are participating with us today. We have a range of banks that have been involved in the credit sensitivity group conversations. We have borrowers of different types, and so we're really pleased to have borrowers with us as well. And from the official sector, we have representatives from the New York Fed, the Federal Reserve Board, the Treasury, the OCC, FDIC, SEC, and CFTC. So I'm really pleased that you can all join us today. We also have presenters that we'll hear from American Financial Exchange, Bloomberg, ICE, Benchmark Administration, Market, and Professors Burnt and Duffy as well. So we're delighted to have you all as presenters too. Let's turn to the agenda briefly. Monica, you want to just walk us through what we'll cover today?
Sure. So we have 30 minutes assigned to each presenter, and we'll go through in the order we have here. In terms of questions from the audience, we'd encourage folks to type those questions directly into the chat in WebEx and send them to the group, and then the presenters can address them as they wish. That's all I have.
Great. So why don't we go ahead and get started. Our first presenter is IHS Markit, and I think we're running right on time. So I will turn it over to the Markit team.
Great, thank you, and good afternoon, everyone, and thank you for inviting us to present today. By way of introduction, my name is Ed Chidsey. I'm a partner at the firm with responsibility for our information services business. This encompasses all of our data valuations and index businesses, as well as the suite of capital markets technology solutions that we operate in the primary markets. I'm joined by a few of my colleagues. Dan Husher. Dan leads our global product development team and has specifically led the development of the credit product that we'll discuss today. Julian Ray manages our global Libor transition program, and Tasha Gomska is the lead for our North American business development team. I'll provide a brief overview of our capabilities as a firm and then turn it over to Dan to talk through the specifics of our proposal. So if you can just move maybe 2 slides ahead. Just briefly, at our core, I think the next slide. Yes, thank you. At our core, IHS Markit is an information company. We provide a wide range of data and analytics offerings across multiple industries, not just financial services. Financial services is our largest segment, but we also have significant businesses focused in other industries such as energy, natural resources, automotive, maritime, and trade, and a number of other areas. We're a large global company. We have over 15,000 employees, publicly traded on New York Stock Exchange under the ticker INFO. We're also part of the S&P 500. So if you just flip to the next slide, I'll just quickly touch on some of the capabilities that we think are most relevant to our credit spread offering. As you likely know, credit really is in our DNA. It's where we started as a company, and we've progressively grown our suite of capabilities across the whole range of data valuations and index services. We pride ourselves on the depth and breadth of data that we consume to drive our businesses. As an example, this includes 23 million market data inputs on a daily basis. Managing this is only possible through a significant investment that we've made in technology. And this, extends beyond our pricing business to our index business as well, which is historically focused on credit and fixed income. And then finally, and certainly relevant, I think, to this conversation, is the robust framework that we've put in place around benchmark administration that governs all of our index businesses. This extends actually beyond financial services to other areas like our oil price indices as well. So in short, we feel we're well positioned to deliver a credit spread adjustment rate that will help banks to properly incorporate a credit risk adjustment alongside the new secured reference rates. So with that, I'll pause. I'll turn it over to Dan to talk through the specifics of our credit rate process and methodology.
Great, thanks, Ed, and thank you for everybody for taking the time out of their busy schedules to be with us today. What we're going to present today is the market has had the opportunity to provide some feedback to us, and we certainly found that hugely valuable in kind of shaping the product. So we do appreciate that. Kind of what you're seeing here over the next couple slides are several months of testing a variety of different data inputs and sources, thresholds, and different methodologies, to just name a few. So we certainly did appreciate that. So Monica, if you could move forward to the next slide. We'll start with a tear sheet, if you will, of sorts, but brief product overview of what this is meant to be. The IHS Markit Credit Spread Adjustment is designed to be a broad-based measure of average marginal funding spreads for banking institutions that are funding in U.S. dollars in institutional markets on a senior and an unsecured basis. We will generate a spread, which will allow for the adjustment of secured reference rates to include a credit component. So we'll actually pause that thought right there. A colleague of mine, Julian, will talk about kind of expected use cases, in subsequent slides. But moving back to the product overview, at the 10,000 foot view, the inputs that are being used are transactions of certificate of deposits, commercial paper, as well as corporate bond transactions. And in some instances, where needed per the methodology, we also include indicative price quotes. We do also filter the data. Filtering includes various institution types. For this, it's specifically to banking, transaction size, coupon ranges, issuance days to maturity, and various characteristics of bonds that we filter on. From a methodology perspective, we ultimately landed on a bucketing and median approach. That's something that we found very beneficial from kind of our feedback from potential market participants and users of the product. We do also include threshold counts around transaction numbers at each bucket. And then we also do have an outlier testing at the bucket level. As I briefly mentioned earlier, kind of indicative price quotes, we do have a fallback mechanism in which the transaction thresholds are not reached. We do have the ability to leverage indicative price quotes. We also limit the input around the issuer names. So this is to prevent any domination of any one particular name, significantly influencing the index. It's US dollars, and we will publish tenors across 1, 3, 6, and 12 months. And we also expect this to be published consistent with SOFR on a daily basis at 8 a.m. Eastern. So Mike, if we can move to the next slide, we'll go a little bit deeper into the, into the methodology and the workflow itself. So we've been able to test this methodology over a 5-year period. And when we start to think about, the design of our products and how we should start thinking about it, we look at things like how simple it could be, the transparent, nature of it, how accurate it is in measuring what it's meant to measure, as well as consistency. And in other words, how confident are we that we can produce this value every single day for the marketplace. So starting at the top of the workflow, so to speak, we do filter the data for both static and dynamic thresholds. We think dynamic thresholds are important as market dynamics change and funding behavior changes in the marketplace. We think that it's important that the methodology can reflect those changes in the marketplace via the methodology. As I mentioned earlier, we then bucket those data points across 4 tenors. We then provide the outlier test, which is 2 standard deviations, to clean the data within those buckets. Should we not reach a given threshold, we do have a fallback mechanism for indicative price quotes to be included in our methodology. And then from there, we move on to the weight per source to normalize a change in source data. So let me pause here just to provide a little clarity around what this is. What we're attempting to do at this point in the stage is to control for any changes in underlying data that may not be reflective of changes within rates in the marketplace. Right? So that's what we're attempting to do at this stage in the methodology. And then we also employ a weighted median approach for within the bucket. So what this is essentially is we have the targeted tenors, as I mentioned before. The closer you are to those tenors, the heavier weighting you will have in the methodology. And as you move farther away from that point within the bucket, your influence on the end result becomes less as you move away from that defined tenor. Finally, we take a linear weighted average over the last 5 days. And just to make this clear, we fit the data with the current day's data, and then we take a linear decay function over the last 5 business days to end with the rate. And as mentioned before, we then will convert that to a spread for the market to use as they see fit. So again, that's the product and the workflow of the product from a very high level. Monica, if you can move to the next slide, please. Great. So what does the methodology look like and how does it perform over varying market conditions over the last 5 years? So here we chose the 3-month tenor. On the left-hand side, we have charted our benchmark rate. Again, I don't want to confuse people here, but we thought it would be important for people to understand kind of where the spread is derived from, but we show our all-in rate next to the corresponding Libor tenor over time, and that is on the left axis. And then on the right axis, you see the credit spread values. We converted that to credit spread over the SOFR swap rates, and as a proxy for the historical values where SOFR wasn't either prevalent or available, we used the federal funds rate as a proxy for those that wanted to understand how the spread would change in history. In the charts, the 4 charts on the bottom, we have again the 4 tenors. We wanted to really drill in at an interesting time around the March time frame. Here you can see where each tenor behaves over that month's period, how it behaves relative to Libor, as well as how our credit spread had behaved over the course of March. If you move on to the next slide, Monica. Thank you. We also wanted to show some transparency into the underlying data and volumes that we're seeing. So working clockwise from the top left, we start with the eligible transaction count. I just want to make one thing clear here as well. This is post-data cleaning and selection and filtering. So this is the actual data that's going into the generation of the spread. So the transaction counts are to the left across the 5-year period. Moving to the right, you see the eligible bond count. Okay, so this is the number of instruments. So we have both the transaction count and the number of instruments that are included over time. Below that, we have the total trade volume per day. You can see that we sit between 5 and 10 billion in volume. And then moving over to the left from there is the price quote count. We wanted to show this. In our back testing, we only actually had to fall back a handful of times on the indicative price quotes over the 5-year period, but we wanted to kind of show to the marketplace, at any point in time, the eligible price quotes that are available to the algorithm should we need to fall back on it. Okay. So I'm going to pass it over to my colleague Julian, who's going to talk a little bit about the benchmark and IOSCO principles and expected use cases.
Thank you, Dan. So if we can move on to the next slide, please, Monica. Thank you. So I guess in the last couple of slides before we open up for questions and hopefully some comments, we wanted to focus on the IOSCO principles for financial benchmarks, which is obviously a critical point as we are talking about delivering here a critical benchmark that will be used in a broad variety of use cases. So just as a quick reminder, the principles represent a set of practices that should be implemented by benchmark administrators and submitters, including benchmark governance, quality, and accountability mechanisms. And at IHS Markit, we operate in accordance with those principles across all the indices that we administer. So in the introduction, Ed mentioned the fact that we were a very established index provider. We are currently administering about 40,000 indices globally, and all of those indices are administered in line with the IOSCO principles. So the USD credit spread benchmark adjustments will be no exception to that rule. In addition to IOSCO principles, we also comply with the benchmark regulation in Europe, the BMR regulation, across our index franchise as well. So maybe going back to all of the 3 points of the IOSCO principles, the first one is the governance, the second one is the quality, and the third one is the accountability. On the governance, I've mentioned that our benchmarks are calculated and published and administered in line with the benchmark regulation. We've got an administration called IMBA for IHS Markit Benchmark Administration in the UK. That's been authorized by the FCA since July 2018. We also have a European branch of this administration that's authorized by HAFME since November 2019. So that allows us, under BMR regulation, to administer indices and benchmarks both in the UK and in Europe without any problem. We are an early adopter of the BMR protocols, and there's still some time for administrations to comply with those rules before the end of 2020. But as you can see, we've been adopting those guidelines and principles since early 2018. We are also recorded on the ESMA register of benchmark administrators. So I spent quite a bit of time on BMR here, and the reason why is the rules and the guidelines and the regulation under BMR are very prescriptive, and it gives us de facto a compliance to the IOSCO principles that are to a certain extent a bit less prescriptive. So from a governance perspective, this is where we stand. The second point in terms of IOSCO principle is the quality of the benchmark and the methodology that underpins the calculation. So in terms of that, my colleague Dan just went through the methodology and the care we've taken in preparing and in constructing that benchmark. Our benchmark calculation is based on transactions at the level 1 of the waterfall, which is the highest quality ingredient under IOSCO principles. We've only fall back to using indicative price quotes on 3 days out of the 5 years of backtesting that we've done. And we went through the COVID period without using any of those fallbacks. So typically that happened on days where there was an extended bank holiday, for example. So the key point in terms of quality is we are using transactions at the level 1 of our hierarchy, and we are using this level 1 for more than 99% of the time. And I guess in terms of methodology, I'm not going to go back to what Dan covered earlier, but obviously we've got very clear criteria, very clear documentation on how the benchmark is calculated and constructed in line with the IOSCO principles. We've had a lot of bilateral engagement with many of the firms that are represented today to come up with a set of rules that we hope will work for most. And we intend to also operate an advisory committee and consultations after this call to ensure that we are inclusive in terms of the approach that we are taking to build the benchmark. And I guess the final point of the ISCO principles is around accountability. So again, with our established benchmark administration, we have identified for this benchmark that we have about 25 documents that we'll have to publish. Some of them are relating to the benchmark administration itself, and some of them are relating to the benchmark per se. And obviously those documents will be made available to everybody when we are going live with our product. We've also engaged and we will continue to cooperate with the regulatory community as required by the ISCO principles. So if we move on now to our last slide, Monica, please. So in terms of the expected use cases, we intend our benchmark to be a dynamic credit-sensitive benchmark for the institutional markets. And it will provide exposure to funding spreads for banking institutions that are funding in US dollar in the institutional markets on a senior unsecured basis. So the main use case, and it's not going to come as a surprise to anyone in the call today, is going to be in the loan space. And the use of a dynamic credit-sensitive benchmark like ours will ensure that banks are compensated via higher lending rates at time when their cost of funding can rise, and will protect their interest margins. We will update it daily, and it will be reflective of market conditions. You've seen on some of the graphs that we shared earlier that it's a benchmark that's fairly responsive to market shocks, as well as being very stable over time. And we will be publishing standard tenors for 1 month, 3 month, 6 month, and 12 month in line with the existing Libor tenors. So in terms of use cases, I guess minimizing the value transfer on legacy USD Libor position is key at Libor cessation dates. The benchmark will be able to, it can be used as an add-on to SOFR, as an alternative to more static fallback rates, such as the ISDA fallback rates. But it's not restricted in terms of what type of underlying rate it can be used as an add-on for. And we are deliberately publishing a spread to allow for the flexibility of the usage for those firms that need a credit-sensitive benchmark, and we don't want to tie it to any underlying rates. And I think I'm going to close with this comment, and that's key to us as well. We do not want to impede the adoption of SOFR as the benchmark that's recommended by the ARC committee, and the publication of a spread, to our view, will allow the firms that can use SOFR in a compounded way or in any other way to use it as an add-on without impeding the adoption of the benchmark SOFR in the US. So I guess that concludes our quick presentation for today. We hope this gave you a good overview of what we believe will be a great product and a great benchmark that will hopefully facilitate the transition away from Libor. I guess if there is still time to take any questions or comments, we are more than happy to address those now or in discussions after the forum for those firms that may not be prepared to talk today. So thank you very much, and yeah, hope you have any questions.
If you have a question, please type hand.
Julian, thank you, and the team. Yeah, thank you, Julian, and the team for that presentation. Let's open it up and see if there are any questions from the audience. You can type hand, type in the chat, click hand, or if you want to come online and just ask a question, feel free to do that as well.
Nate, there are no questions at this time.
Raise their hand or raise a question. None. Why don't we move on to our next presenter? Thank you, Market, for your presentation. And so our next presenters are Professor Berndt and Duffy. So can I turn it over to the two of you?
Professor Duffy, please unmute yourself.
Thank you. Thanks, Nate. I'm here with my colleague, Professor Antje Berndt of Australian National University, and we're going to present this together. Antje is up in the middle of the night in Canberra, Australia, so I'm very grateful to her for sharing this with me. I just want to be clear that we're offering an approach here as academics. We are not campaigning for anyone to adopt this approach. We have no business, we have no commercial interest in doing this, and no intellectual property. This is just open source approach. And I'm going to motivate this approach, which is an across the curve approach, and then I'm going to turn it over to Antje to explain the construction of the index, or at least the prototype of the index that we have in mind. Could I have the next slide, please, Monica? So we're starting with the premise that the IOSCO principles are important, and a credit spread, dynamic credit spread benchmark should be robust. It should be representative of marginal funding costs of banks, and it should be flexible to changes in bank funding patterns. And one of the reasons that we're here today and working so hard on finding a good approach is that banks have changed their approaches to funding over time, and because of regulation, it's difficult to estimate a 3-month, for example, a 3-month credit spread accurately. It's not to say it's impossible, but it's quite difficult. And our approach is not to try to suggest a particular term rate, but rather to go to what banks are actually funding, to get their average marginal funding cost, which is spread across the maturity curve. We also think that a successful approach to this is likely to generate substantial amounts of derivatives trade, and it probably should. There are good reasons for borrowers and lenders and other investors to use a credit spread benchmark to hedge and risk transfer in this space. And that's going to put additional onus on the robustness of this index, whatever it turns out to be. And there is a very strong business use case for it. So I hope that one of the approaches you're hearing about today or some other approach will end up being adopted in practice. The difficulty with getting enough transactions data at any particular term point suggests going to a broad set of transactions from across the curve. Now, just yesterday, Bruno Dupier at Bloomberg explained the Bloomberg approach, which you're going to hear about later today, which goes beyond transactions data to use executable quotes. And I was very impressed by the presentation. If the executable quotes approach turns out to be well-founded, that could be a useful way to supplement the available pool of transactions so as to get a robust approach. But just based on transactions alone, there don't seem to be enough based on the Fed 2420 data to do this in a robust way at a specific term. So we're going across the curve as our approach. In point 4, we're going to use trace data to go past the 1-year point and estimate wholesale unsecured funding spreads within each maturity bucket out to 5 years, and then average across maturity buckets by issuance so that we get a fully across the curve approach. The composition of, we find, by the way, that the composition of unsecured issuance volumes does vary quite substantially over time. So banks are shifting their sources of funding, and a credit spread that reflects actual marginal funding costs should also switch its emphasis by tenor as banks change their funding patterns. Next slide, please. Thank you. So Antje is going to explain the construction of this, but just let me give you an idea. The red, I think it's red, I'm colorblind, dotted line at the top is the beyond 1 year average credit spreads. The blue dashed line at the bottom is the within 1 year average credit spreads, again across the curve within 1 year. And by the way, we're Tim Bowler of ICE Benchmark Administration generously gave us the data with which to produce the blue line from ICE data, and because we don't have access to money market data like many of you do, and across the curve benchmark, a representative one, it could be, for example, the black line, which is simply the average of the two, or it could be a weighted average. This is just to give you an idea. Again, Antia is going to review the construction in a moment. You can see it happens that between the end of 2017 and late 2019 that the short and long-term spreads were highly correlated. But that's not always the case. Monica, if you go to the next slide, I can explain what I mean. Thanks. So what's shown in this slide in blue is a fraction of the across the curve index. So this is basically a scaled down version of the across the curve credit spread that I mentioned a moment ago. And in red is the difference between Libor and compounded SOFR over the last 5 or 6 years. And you can see they don't move at all together during certain periods of time. Well, actually, I've had a couple people get in touch with me after looking at this and say, gosh, you haven't done very well because you haven't approximated 3-month credit spreads very well. And I think we were not communicating well enough if that's the message that one takes from this slide. Rather, we would suggest that the Libor SOFR spread actually doesn't represent marginal funding costs very well. It's the blue line that is the actual marginal funding costs. And we are not trying to approximate the Libor SOFR spread. We're not trying to approximate 3-month credit spreads. We're trying to get an average of across the curve approach. So this presents some complexity for people to get used to if it's adopted as an approach. And that's one of the disadvantages of what Antia and I are proposing. It's a completely new approach that people would have to get used to. I remember when people were trying to wrap their head around the idea of compounding overnight rates to get a substitute for a term rate, and some people suggested nobody is ever going to try something quite that different, and here we are today. I'm going to pass now to Antia so that she can explain the construction of the across the curve spread in more detail. Thank you.
Thank you, Daryl. Monica, if you could please go to the next slide. I'll provide a little bit more detail and emphasize some of the issues Daryl already talked about. So just to review again, the AXI is designed to measure recent US dollar wholesale unsecured debt funding costs for public bank holding companies and commercial bank subsidiaries that are domiciled in the US. And the index is constructed as a weighted average of spreads across the entire curve, starting from the short end going out to about 5 years. And the index construction basically is made up of a sum of a product of two terms, and the two terms are created as follows. So first, we go maturity bucket by maturity bucket, and within each maturity range. So for example, maturities of bonds that have 4 to 5 years outstanding until expiration, we line all the transactions that we observe in the trace data over a reference period, let's say the trailing 1 month, line them up by years, and then identify that yield where half of the transaction volume is below that yield and half of it is above that yield, and call that the median within bucket yield. We subtract off of that the risk-free reference rate, and that gives us the bucket-specific credit spread SM. And that reflects the pricing of debt that trades within that maturity bucket in the recent past. And we do that computation for each of the maturity buckets out to 5 years that we have. And then we weigh across these maturity buckets according to the actual debt issuance in the recent past. At the moment, we use the trailing 12-month issuance pattern of large bank to weigh across buckets. And that informs our across-the-curve credit spread index. So what goes into these buckets for maturity above 1 year, we basically include instruments that are senior unsecured corporate debt issues, medium-term notes, medium-term zeros. We sort of try to balance the homogeneity of the pool of instruments that we base our yield computations and spread computations on versus including as many transactions and keeping as many transactions as possible to compute these yield spreads. So for example, at the moment we suggest excluding foreign currency, private placement, convertible, exchangeable, perpetual, and so on. Those kind of debt instruments that make within bucket comparison of yield spreads more difficult. We exclude them currently from our computations. And then for money market maturities, as they said, we don't have the data ourselves. We kindly were provided with some from ICE, but there you would include transactions at 1 day, 1 month, 3 months, 6 months maturity points. And you would replace the trailing issuance amounts that go into these weights queue for these short-term issues with current outstanding amounts and perform your scaling as desired to, with the overarching goal basically being to reflect the actual debt maturity structure of banks. So this is the index construction regarding the underlying data. I have a couple of plots to show you. Monica, if you could please advance. Thank you. So this is the underlying transaction data that comes from Trace. I'm focusing now on the data that we can actually work with, starting at the 1 year maturity point going out to 5 years. And you see, if you look at monthly frequencies for the time being, in recent years, you have about 10 to 15 billion in terms of transaction volumes in these 4 maturity buckets. This is the data that we use to compute these maturity bucket specific credit spreads. And the credit spreads I show you on the next slides that we produce. If we could please move ahead. Thank you. So here on this slide, you see for each of the maturity buckets from 1 to 5 years, the median volume weighted credit spread that we obtain in red. And then around these median spread curves, the SM in our index computation, we also show you the interquartile range of the spreads. And you see that in recent years, the price information that you had within buckets across all bank holding companies, commercial banks, were actually pretty tight. But of course, at times of distress, there is more movement in these yields. And this is also reflected if you look at the 2011 time point in these plots by a wider range of spreads that enter these computations. So this is essentially the SM, the spread component that goes into the index computation. And these spreads are now weighted with issuance volumes that I show you on the next slide to represent the actual issuance pattern of banks. So if we go to the next slide, you can see the data that underlies these weights QM with which you weight the maturity specific spreads. And you see that at least for the longer term maturity buckets from 1 to 5 years, there is, as Daryl said, substantial variation over time in where issuance occurs. So over a long stretch of time here, we see most of the issuance occurring in the 4 to 5 year maturity range. But if you go back further, closer to just after the JFC, you see, of course, that the maturity structure looked quite different from what we see in the more recent past. So whatever it is, whatever happens in the market and whatever transactions are recorded, this is reflected and enters directly into the weights that we use to form our index. All right, so this is the data underlying the AXI index. The next slide shows you how the index looks like post-JFC. So in blue here, the solid line, you see the time series of our AXI index. And what is remarkable about this plot is not just the pattern in this, what it is. This is the information obtained from the market, but what is remarkable is how closely the AXI index is really correlated with an alternative index that we call the FXI, or the Financial Conditions Credit Spread Index, that widens the base of issues used to compute the index to all corporate bond issues. So if you relax the condition that you just look at issuance by large bank holding companies and commercial banks, to include the issuance and the bonds traded by all corporate bond issuers, and repeat the same index computations that I went through, you obtain the red curve. And you see that over the recent past, the FXI is very closely correlated with the AXI. And the nice thing about going to a broader set of issuers to underlie your index computation is, of course, that you increase the robustness of your computations. So if you, Monica, please go to the next slide. What we noticed is that if we enlarge the issuer base, we go from transaction volumes for banks that I had already showed you and that I now replot here in blue at the bottom of the figure, that was about 10 to 15 billion transaction volume per month after the stringent cleaning that we currently impose on our data, to about 60 to 80 billion per month. So you increase the number of transactions on which to compute your index on by a factor of nearly 5. And that sort of certainly increases robustness of your computations. You could restrict this. We have tried restricting the broader issuer set to just investment grade issuers. The indexes, since we look at median spreads, look fairly similar to the one I just showed you. So you have some flexibility, but the important message is that you could venture out even further and include a broader set of issues to increase the robustness of your index. All right, so the next slide, I think, wraps up and provides a little summary of what Daryl and I talked about. So to conclude, just to review, the AXI across the curve credit spread index that we constructed is a measure of the recent cost of wholesale unsecured debt funding for public U.S. bank holding companies and their commercial bank subsidiaries. The index we propose is a weighted average of credit spreads for unsecured debt instruments and representative of a wide range of maturities from overnight to 5 years ideally. The weights in the index reflect both secondary market transaction volumes and primary market issuance pattern. In filtering the data and deciding what goes into the index computation, we are trying to strike a balance between basing spread index computations on as homogeneous a set of bonds as doable while retaining as many observations as possible. So this is a little bit of a trial and error that goes in there to come up with the most reasonable set of criteria for your data filters. And what I remarked on at the very end is that incorporating transaction data for non-bank issuers scales up the dollar volume of the covered transaction significantly, defined by a factor of nearly 5. And we also see that the resulting broader base spread that we call FXI is highly correlated with the AXI spreads, especially over the past few years. Thank you. So this is all we wanted to say at the moment in prepared remarks, and I think we are happy to take questions.
Thank you. Thank you very much, both of you. We really appreciate the presentation. Let's open it up to questions from the participants. Hearing none, we'll move on to our next set of presenters. Thank you, Professor Duffy and Professor Behrens. Very much appreciate you presenting today. I'd like to hand it over now to IBA.
Nate, it's Tim. Can you hear me okay?
We can hear you great. I know, Tim, you're multitasking with a PC and a phone line, so thank you.
Excellent. Well, no, first and foremost, my thanks to the Federal Reserve Bank of New York for hosting this session, giving us the opportunity to present. And then secondly, my thanks to the group attending. We really appreciate the opportunity to share our thoughts on this subject matter and to present the work that we've done to date. So, just as I kick off, there's really 5 key points that I wanted to leave the group with today. First and foremost, one that, it's our belief that a credit-sensitive rate can provide benefits to both lenders and borrowers, and I think that's helped motivate our work on this topic over the last few years. From a lender's perspective, retaining a credit-sensitive rate, particularly within the context of their unfunded revolving commitments, can be very useful, as it will provide a hedge to their underlying funding risk. For borrowers, lenders' willingness to continue to provide meaningful revolving lines of credit that provide access to deep contingent liquidity at attractive prices should be retained within the context of retaining a credit-sensitive rate. And that ecosystem ultimately might be disturbed if lenders are forced to provide or price revolving lines of credit against a rate that can move in an inverse direction relative to their funding cost, particularly during periods of stress. The second key point that I wanted to stress with this group is that it's at least our belief at IBA that unsecured bank yields can be measured on a consistent basis in the money markets, and as a result, a representative benchmark can be built off of this data set. And whether that be in looking at wholesale deposit transactions, commercial paper transactions, certificates of deposit, transactions in the unsecured bonds of banks, we see activity day in and day out in that market. And in particularly, if you're trying to measure that that activity over a multiple-day time horizon, just given the fact that bank treasurers come into the market and borrow on a term basis more sporadically relative to having to roll an overnight position, we just have the view that you can measure accurately and in a representative fashion unsecured and marginal yields of banks for bonds in the money markets. The third key point is that IBA's approach with the bank yield index, which has been the supplemental index that we propose to that could serve as a credit-sensitive lending index within the context of SOFR being stood up, is our approach has been to build an unsecured bank yield curve based upon transactional data only. And the reason for this is we wanted to stay as anchored as possible to the IOSCO principles, that really do stress the importance and desire to have benchmarks anchored in transactions to the greatest extent possible. And from that unsecured bank yield curve that we can produce on a daily basis, we can extract or pull out term settings that borrowers and lenders are used to working around, a 1-month setting, a 3-month setting, a 6-month setting. The fourth key point I wanted to stress for this group is that IBA has the technology in place today to create a direct nexus to SOFR, if you will, a SOFR plus. And the ability to do that really stems from the fact that you can measure and create an unsecured bank yield curve and then convert that to an unsecured bank credit curve that could easily be put on top of either a SOFR calculation that's compounded daily and then priced at the end or used at the end of the transaction, or if it becomes appropriate at a later date, could be placed on top of a forward-looking term SOFR curve if one can be produced in compliance with the IOSCO principles. And finally, from our perspective in regard to next steps, particularly given the need to transition off of Libor, we're working with banks today to secure the agreements that would be necessary to ensure on an ongoing basis that we have access to best-in-class data to build the bank yield index in order to make certain that both borrowers and lenders can have confidence in the underlying benchmark on an ongoing basis. So with those 5 key points in mind, Monica, would you mind moving ahead by 3 slides, and I'll just start covering the data universe that we're looking at. Great. So as I mentioned in my opening remarks, our efforts have really been focused on looking at transactions in unsecured bank debt. And those efforts have really been focused on 4 key markets because we have access to, and we think there will be ongoing access to, a deep and rich transactional data set. And first and foremost, it's institutional certificates of deposits, secondly, commercial paper. Third is the universe of wholesale unsecured deposits that get directly placed between banks and their institutional clients. And then finally, unsecured bonds that have rolled down the yield curve. So these are the unsecured debt that Professor Duffy and his group have mentioned that have been issued by the banks, and certainly in significant amounts post the financial crisis, that are rolling down the yield curve and trade in the secondary markets. And as a result, their yields can be observed and combined with the primary money market activity can be measured to create a bank yield curve. And turning to the next slide. Monica, do you mind turning to the next slide? That'd be great. What we've noticed is that there's a rich and significant data set that occurs in these markets on a daily basis. And to date, over the last couple of years, we've been working with 14 internationally active or large global banks that have allowed us to use their data set to evaluate their primary funding activity in the money markets. And looking at the bonds of 30 large internationally active banks that have rolled down the yield curve. And we've been evaluating the transactional activity based upon those 2 data sets on a daily basis, based upon a refined category. And what I mean by a refined category is we're really trying to look at what we would consider best-in-class data points in order to be able to construct an unsecured bank yield curve. And from our perspective, that means really focusing on the larger institutional in nature transactions that would help ensure that the underlying pricing dynamics that we're looking at are wholesale in nature and really representative of where an institutional investor would be willing to invest in a bank on an unsecured basis. As such, our efforts have really been focused on primary money market transactions that at least are 10 million greater in size. And then secondly, secondary market bond transactions and the unsecured debt of banks that are 5 million and greater in size to make certain that the transaction is in fact representative and does measure where a sophisticated investor would be willing to invest on an unsecured basis in banks. Turning to the next slide, Monica. And in order to make certain that we're doing this on a consistent and representative basis, and also in a manner that represents actually how, and particularly in the primary markets, how bank treasurers fund themselves, we tend to look at this, we use a rolling 5-day basis in order to come up with our measurements. And the rationale for that was actually driven by a number of the interactions that we've had with bank treasurers over the last couple of years, where they note that they'll come into the money markets to execute term transactions, a 30-day placement, a 90-day placement, a 180-day placement, and one-year placement on a more sporadic basis, a couple times a week as opposed to every single day. Because given the fact that the underlying transactions are in and of themselves have liquidity embedded in them, meaning that a 30-day placement means that the bank is getting liquidity for 30 days, a 90-day placement means the bank is getting liquidity for 90 days. They don't need to necessarily transact in the money markets every single day. But on a week-in and week-out basis, you'll actually see a significant footprint across a wide spectrum of banks and their activity in the primary markets. And then certainly, given the dynamics in the secondary bond market, as those bonds trade as they roll down the yield curve, measuring on a week-in, week-out basis, you'll be able to capture a wider and more diverse data set. And I always stress that you have to remember this is different than an overnight index, which is inherently going to have a deeper volume set, because those underlying transactions have to be rolled every single day. So where if a bank treasurer places a $100 million piece of commercial paper for 90 days, they don't have to roll that transaction for 90 days. Or if a bank treasurer places a piece of commercial paper that's overnight maturity, they obviously have to roll that every single day. And hence why you can see such large disparities in volumes between something that might measure an overnight market relative to something that might measure a market that has more term associated with it. Monica, if you could change to the next slide, it would be great. And this slide just quickly demonstrates the breakdown in the transactional data that we see between, in the blue section of the chart, unsecured wholesale deposits, green certificates of deposit, and orange commercial paper. Turning to the next slide. So what do we do with this data? We undergo a 4-step process. First, as I mentioned earlier, we aggregate all the eligible transactions over a 5-day window, and we'll increase this window if necessary to meet minimum aggregate trade count and volume thresholds that I'll discuss in further detail on the next slide. Secondly, based upon this data set, we calculate a fitted unsecured yield curve, which is displayed on, which is displayed on the next page that we'll go to shortly. We calculate a fitted unsecured bank yield curve using a regression analysis across all the eligible data points. Third, we review the transactional data points against the fitted curve to identify extreme outliers for exclusion. Currently any trades that are plus or minus 200 basis points above or below the curve. And this is just to ensure that there aren't unrepresentative data points or errors in the data that might have been submitted. And then we refit the curve process again to ensure that we have what we believe is a representative bank yield curve that represents average unsecured bank yields. And then finally, the 4th step is based upon this yield curve, we extract a 1-month, a 3-month, and a 6-month setting. So Monica, if you wouldn't mind turning to the next page. And this is graphically displayed on the slide that's in front of you right now, where if you look at the underlying dots on the page, and they're color-coded from the various transaction dates, this represents 5 days of unsecured funding and secondary market bank transactions that we observe to meet our minimum standards. And based upon those 5 days of transactional activity, we produce the blue yield curve that's in front of you. And that blue yield curve is the best fit average unsecured yield curve for banks. And from that yield curve, we can extract a 1-month setting, a 3-month setting, and a 6-month setting. Turning to the next page. And we've been testing this over nearly a 3-year time horizon since we came up with the concepts within the context of the need to sunset Libor. And as I think the charts this chart demonstrates, it certainly has been correlated with other money market indices that have been widely used. And certainly during periods of stress displays what one might expect within the context of a benchmark that's credit sensitive and liquidity sensitive relative to a risk-free rate, which we used Treasury yields as a proxy for these charts. And as noted at the bottom end of the chart, we're currently displaying and publishing test rates updated daily on our website. And so I would encourage the group to please, if you have the opportunity, to go evaluate those rates and look at the data. Turning to the next slide. We've also built what we view as very much a common sense calculation contingency, where, going back to our core principle that we wanted the underlying benchmark that we were producing to be as anchored as possible in transactions and unsecured transactions, while at the same point in time making certain that it was based upon a wide and diverse data set that encapsulated both primary market transactions from a wide set of banks as well as secondary market transactions from a wide set of bonds. We set minimum thresholds from both a volume perspective and transaction count perspective that need to be met not only on a collective basis but across the yield curve. And if these minimum thresholds aren't met, we end up incorporating another previous day's worth of transactional data into the calculation of our index. And what that means in practice is if 5 days of data, 5 days of transactional data, the refined transactional data that we're using, isn't good enough to meet these minimum standards, we look back 1 day to add transactional data in order to produce the index settings. And the reason why we chose to do that is, as I said earlier, one, to make certain that the transaction remains to the greatest extent possible anchored in transactions. And then secondly, just to have consistency within the input of the data set that's being used. And thirdly, and this is, from our perspective on, just taking a step back and evaluating the common sense approach, we're trying to build a credit sensitive index that might be used for lending markets that represents unsecured bank funding costs. So it's credit in nature and it's measuring liquidity premiums in nature. And those cycles will evolve over time. They'll evolve over a multiple day time horizon, and they'll increase over a number of days, and they'll decrease over a number of days. They don't really move around sharply the same way interest rate benchmarks might change within the context of rapidly changing monetary policy expectations. So pulling in transactional data from over a multiple day time horizon, we think is actually going to ultimately be more representative of conditions in the credit market, relative to just trying to use 1 day's point-in-time transactional data set that can be skewed based upon who's transacting in the market at any one given point in time, or when you have periods of either holidays or a lack of liquidity in the market for other exogenous factors. But at least what we've noticed to date in our testing over the last 3 years, it's been very, very rare that we've ever had to incorporate lookbacks in order to meet our thresholds. And when we have had to do lookbacks, it's only been for one incremental day. Turning to the next slide. As I noted in my opening remarks as well, we've also built the technology to take the bank yield index data set and the methodology that we've used and create a direct nexus to SOFR, a SOFR plus methodology. And the way we've done this is by just converting the underlying yield data that you saw earlier and converting that to a spread to implied term SOFR rates. And as the chart displays on the right-hand side, we took that yield data, converted that data into credit spreads by looking at where those yields are, how those yields compare to implied term SOFR rates, subtracted the two, and came up with spreads. And based upon that spread data, we're able to create that blue line, which is a best fit credit curve for the underlying transactional data set, which from our perspective we think makes sense to use as a unsecured credit curve to risk-free rates, term SOFR rates, from which you could extract a 1 month or a 3 month or a 6 month credit spread that represents average unsecured unsecured credit premiums observed in the markets relative to a term risk-free rate, that being an implied term SOFR rate. And these spreads can either be added onto a term SOFR rate, or as I mentioned earlier, they could be added to an interest rate calculation based upon SOFR compounded on a daily basis and paid in arrears. So just having the flexibility to create both a yield-based benchmark and a spread-based benchmark that could be attached in underlying lending agreements, we think offers great flexibility. Furthermore, it could also allow over time for a bifurcation for the underlying inputs to the benchmark, where you could refresh the term SOFR curve on a daily basis to make certain that it's capturing as rapidly as possible changes in monetary policy expectations, while using a richer and more broader set of credit-based information over a rolling 5-day time horizon to build that credit curve, which will probably, or at least from my perspective, build a much more informative and representative credit curve from which to measure liquidity and credit premiums in the unsecured bank wholesale markets. Micah, if you wouldn't mind turning to the next page. To the next slide. This slide just details this work and the testing results over the last year, and the top chart just notes the spreads that we've calculated to implied term SOFR rates on a 1-month, 3-month, and 6-month basis. And then we also, really referencing the concept that Professor Duffy had mentioned, said produce an average credit spread across the money market curve. So this is a little bit different than what Professor Duffy did, where he's looking at an average spread across the a full year yield curve out to 5 years. This is an average credit spread across the money market curve that we've produced to implied term SOFR rates, which is the blue line. And then we just compare that to the average credit spread that's been observed in Libor relative to an implied 3-month term SOFR rate. So flexibility, if you will, to produce a credit spread for either point in time on the curve, a 1-month, a 3-month, or a 6-month setting, or an average credit spread across the curve, based upon what market participants feel would be the most appropriate supplement to SOFR. Monica, can you turn the next slide? And this slide and the following slide just highlights the steps that we'll take to meet the 19 IOSCO principles, which really fall into 4 key categories, which is just governance, ensuring that as a benchmark administrator, we have full control and are responsible for every aspect of governance. Secondly, the quality of the benchmark, making certain that the benchmark has been designed to do what it says in the tin, if you will, and measure unsecured bank yields on a representative basis, and trying to do that to the greatest extent possible based upon transactions that can be observed in the market. And Monica, would you change to the next slide? Third, having a quality methodology that market participants and stakeholders feel is transparent. B, does what it accomplishes what it's trying to measure, and is based upon a code of conduct and an input data set that market participants and stakeholders find credible, and importantly, relies heavily on consultations with market participants, such that there's a positive feedback loop such that the benchmark doesn't get stale. And then finally, taking the responsibility as a benchmark administrator to be fully accountable for how you're producing the benchmark, how you're overseeing the benchmark, how you're surveilling the benchmark, and do that in such a way that the market participants could continue to have confidence in the integrity of how the benchmark is being produced on a daily basis. And this is something that we, as one of the leading benchmark administrators, particularly of systemically important benchmarks, have invested heavily in over the last 6 years since IBA has been formed. Monica, do you mind turning to the next slide? So I'll conclude my remarks today with just an overview of the next steps that we're engaged with here over the course of the coming weeks and months. And they're really fourfold. One is just finalizing our outreach with stakeholders to get advice on core aspects of the underlying methodology that would be used to build the bank yield index, either on an outright yield basis or a spread to SOFR. Secondly, finalizing our methodology based upon the feedback that we received, and we hope to do this by the end of the year. Third, obtaining commitments from a wide and diverse set of banks, not only just Libor panel banks who we've been working with today, but other banks that issue bonds in the unsecured market and use the money markets to use their funding data on a consistent basis in order to build the benchmark. And then finally, once steps 1 through 3 are complete, go live with the benchmark that can hopefully help facilitate an efficient, orderly, and organized transition away from Libor, particularly in the lending markets. So with that, I'll conclude my remarks and see if there's any questions.
Tim, hi, it's Tom Dees. Thanks very much for taking us through this.
You're welcome, Tom.
The one thing that I would just observe, and people have heard me mention this before, is that so we're kind of, all these methodologies attempt to look at the bank's marginal cost of funding, subtract the new reference rate, SOFR, from that, and then the difference is the amount of spread that the borrower should pay. But what keeps getting left out is that we've been paying the commitment fee or facility fee for the commitment of this capital to us, the whole committed 3 or 5 year term of the credit agreement, and nobody's factoring that in. And so it seems like there's an undercount of what the bank needs to earn. Or maybe all the banks can reduce their facility fee or their commitment fee to 0. So I wonder, and I'd invite Professor Duffy to comment on this, like just from a methodology standpoint. What about that other component that we're not figuring in here?
Sure. Do you mind if I jump in quick, and then maybe Professor Duffy can share his thoughts as well?
Yes, absolutely.
So I think, the way I've always thought about this, in particularly within the context of revolving lending agreements, is, and those that have just really been put in place over the last 30 or so years that have used Libor, is that the bank that's lending money on a revolving basis, so obviously is willing to provide liquidity to its client on a minute's notice, regardless of either A, conditions in the market, or B, the underlying health of the borrower, assuming it meets the whatever covenant standards are in the agreement. So it's truly conditional liquidity that's provided from a bank to a borrower. And so as a result, the underlying bank is having to take on the credit risk of that borrower and stands ready to take that credit risk over on a moment's notice, over in many cases, a 5-year time horizon if a 5-year revolver is used. So, the bank, ultimately is giving, an unfunded revolving commitment to a client for 5 years, and hoping that if that credit is drawn, that the bank, the borrower in and of itself doesn't have a severe credit event that could result in material losses for the bank. So it's in that commitment, there's a credit aspect associated with it. Well, at the same point in time, that bank, when it's providing its revolver, that revolving commitment also has to take on funding risk, because when that revolver gets drawn, the bank has to go out and source that funding from some source. And it tends to be from the markets, or ideally it's from the markets, where it can obtain that unsecured obtain that funding, and as a result, it has the risk that it's being forced to go to the markets to obtain marginal unsecured marginal funds, particularly during a period of stress. And so, if you were to migrate the pricing of revolving lending from one in which that was using a credit-sensitive rate in the past, which Libor essentially was, to an unsecured rate, the bank at that point in time is going to be now have risk from both a credit perspective, but also potentially from a funding perspective. And as I said, that might change the ecosystem with how banks interface with their clients, because either A, they're going to think about, do I need to reprice this commitment, or B, am I going to be willing to make the same same size commitment that I've been willing to make in the past on a revolving basis, based upon the fact that my risk, my underlying risk dynamic has changed. And I think that's the big fundamental economic question that's at play within the context of moving away from Libor as a credit-sensitive benchmark to potentially something new, is that really within those revolving funding commitments, in the past, the lender always had credit risk, and the borrower always had daily access to liquidity, really regardless of what was going on in the market or regardless of what was going on with the underlying credit, at the company itself from a credit perspective. But if you change to a risk-free rate in those revolving funding commitments, the underlying economic ecosystem has ultimately changed, because a risk-free rate can diverge pretty dramatically relative to banks' marginal funding cost. But Professor Duffy should weigh in and share his thoughts on this.
Can I just want to interject. I mean, I think, Tom, your question, you also directed at Professor Duffy and Professor Berndt, and I just want to give an opportunity, because this is just I believe, Tom, your question is a general one, and so I want to give the opportunity for each of the presenters to say a word in response to your question if they're interested. And I think, Tom, if I understood your question, it was how do these indices incorporate the idea of commitment fees that borrowers are already paying. So maybe I could just ask if Professor Duffy and Professor Berndt would like to respond to that, and then I'll ask Market and Bloomberg and AFX if they want to say anything on this. We'll use this as part of the general time since we have a little extra time, and then after this question, I'd like to move to our next presenter. If you do have questions that you'd like the full group to respond to, please consider those, and if we have extra time at the end, we can do questions across the panel. Thanks. So let me turn it over to Professor Duffy and Professor Berndt.
Well, I'll comment briefly because I thought Tim laid it out extremely clearly and comprehensively, Tom. In the old days of, the current days of Libor, it's already in the commitment fee for a revolver. So the risk that Tim described, both from the viewpoint of handling potential increased borrower risk and also increased funding cost risk, that's built into the commitment fee on the line of credit. So nothing changes with respect to, if I understand correctly, any of the approaches to credit spread, dynamic credit spread add-ons today conceptually. There might be, depending on the hedging quality of these various approaches, there might be slightly different sizes of commitment fees because they hedge slightly differently, the funding cost side. But they're all basically the same idea as the old days of Libor. You might also ask, well, who should be insuring whom against these risks? Is it the borrower that's getting insurance from the bank that the borrower will be able to borrow at a reasonable spread? Or is the bank getting insurance from the borrower to the extent that the borrower is covering some of the bank's increased cost of funding? So it goes both ways. There is if markets were perfectly efficient, it would just be who is insuring whom. There's also an issue of frictional costs of obtaining funding for banks. And the economics of that do suggest that it is going to be more efficient for the borrower to offer some degree of insurance to the bank for a heightened cost the lines are drawn.
Thanks. If I could just respond to just what you and Tim have said. I mean, I think the general rejoinder is, hey, wait a minute. In effect, we've written you guys, you borrowers, you corporate treasurers, an option, and you can hit us up that option. I think the words Tim used was on a moment's notice. Well, actually, we give you 3 business days notice to borrow on a Libor basis, and as has just been demonstrated by the analysis of bank funding costs, they can issue bank holding company CP on the same day, namely 3 days in advance of when they have to fund the commitment. And so there's a little bit of a cushion there, but basically if the rejoinder is that, hey, we're writing you borrowers an option and you're hitting us up for that at a time when credit spreads could be higher than contemplated, well, we paid you for that option in the form of the commitment fee or the facility fee during the life of the facility. So all this about, hey, you're committed for 3 years or 5 years, yeah, we know that, and we paid you for that commitment of capital, and yet kind of none of that is, I don't, it just seems to me that there's a mismatch here in trying to recoup the full marginal funding costs at the peak of a credit cycle when we paid something to ameliorate that risk over the life of the commitment. Anyway, that's my view.
Let me just open it up and see if any of the other presenters wanted to respond to this dialogue briefly, and then maybe we should move on to our next presenters at Bloomberg.
Yeah, just from our side, Nate, from the IHS market side, I don't think we'll have much to add outside of what Tim and Professor Duffy had mentioned. I think from our perspective, kind of the relationship that the borrowers have across multiple dimensions is kind of between them and the bank, at least from our perspective. So not much to add there.
No additional comment from the Bloomberg side.
Okay, great. Well, let me close the conversation here, and Richard, if you want to pick up on this in your presentation in a few minutes, you can as well. But let me turn it over to the Bloomberg team.
Thank you, Nate. I'd like to thank the Federal Reserve and the officials for inviting us to this forum today. As well, I'd like to thank the banks and the borrowers who are here participating. Over the next 15 or 20 minutes, I'm going to attempt to summarize the Bloomberg Short-Term Bank Yield Index, or as we've come to call it, Bisbee. My name is David Mullen, and I've been at Bloomberg for 23 years. While here, I've been involved in the development of a lot of different products, including our electronic trading platform. Recently, I built the Basket, which is the ETF Create Redemption platform, and now I'm working in the index area, developing new products off our indices. I'm joined today with my colleague Umesh Gajria, who is actually head of the index new product development, as well as Bruno Duclair, who heads up our quantitative research group at Bloomberg. And since there are just a little housekeeping here, since people are a little shy about asking questions, I've asked Umesh and Bruno and some of my colleagues to ask some of the questions during this presentation that we know during our socialization with clients have come up. So we can maybe help you out with some of those questions. Slide, please. The Bloomberg Short-Term Bank Yield Index, or BSBY, measures the average yields at which large global banks access U.S. dollar unsecured wholesale funding. It is dynamic, it's credit sensitive, and it reflects the marginal funding costs for banks at overnight, 1 month, 3 month, 6 month, and 12-month tenors. It's based on aggregated, anonymized data, and it's anchored in transactions of commercial paper, certificates of deposit, and bank deposits sourced from Bloomberg electronic trading solutions, along with the addition of corporate bank bonds, and the data there is taken from Trace. The index is based on transaction-related data. There's no subjective inputs here. It is totally based on transactions that are taking place on the Bloomberg, as well as the Trace data. The index is intended to provide the market with a supplement to SOFR. So earlier in this year, when we were out talking about new products, clients kept asking us, what's Bloomberg doing about the cessation of Libor and potentially creating a credit spread index? We listened to what they had to say. They felt that given our expertise in fixed income and in indexing, that we would be a natural person to create an index to supplement SOFR. So we went to the drawing board to see if we could build such an index. Slide, please. So when we looked at the problem, we rationalized that to be successful, our index or any index would have to be underpinned with 4 basic building blocks. The first block, representative. Bisbee, our index, represents large banks' average marginal funding costs across key tenors. And our rates are calculated using an advanced curve fitting algo to ensure accuracy. Second, the index should be robust. Bisbee is generated from a robust supply of transactions per tenor, as I said, originating on our platform. The index has proven to be stable in hypothetical manipulation scenario testing. Third, the index should be responsive. Rates are published daily on the Bloomberg, and they're based on weighted transaction-based data. Bisbee also has shown to be a leading indicator of funding costs during periods of market stress. Later on, when we talk about correlations to Libor, you'll see that Bisbee has actually been a leading indicator. And lastly, an index needs to be resilient. And Bisbee has fallback logic to ensure that we have sufficient volumes to be used to calculate each rate, even during light periods. Slide, please. So let's take a look at the first step of constructing Bisbee. That would be gathering the ingredients or gathering the data. The transaction data is sourced from Bloomberg's e-trading solutions, plus, as I said, short-term corporate bonds that is coming from Trace. The index is constructed from aggregated, anonymized, executed transactions and combined with executable quotes. I want to be clear, executable quotes are firm offerings that are clicked to trade up to posted sizes. Once the aggregated data is then filtered to retain only the data from a list of eligible banks. Now that list of banks is a combination of global systemically important banks plus the panel banks that are not included in those GSIBs. We remove the state-owned banks because we feel that the credit spread there does not reflect the bank credit. And so we're left with, at this moment, 30 banks. But it's important to note that we have a governance review process that will periodically review that list and make recommendations in light of the current market. It also should be noted that this whole process is under the Bloomberg Index Systems Limited platform. And that is basically the part of our business or the Bloomberg business where all our indices are operated from. Slide, please. And this slide shows or illustrates really how the average contribution of the different instrument types contribute to the various tenors. So you can see that it's no surprise up front with the overnight tenor that's mostly comprised of deposits with some CP. But obviously, as we move out the term structure, you can see that deposits start to slack off. CP, CDs become more of a component. And then as you get further out the term structure, that's where you see the corporate bonds kick in. But again, in terms of their relevant size and importance to the overall mix, they're smaller than the other products. But I think this slide is really intended to explain the rationale that we're using to use a hybrid approach, which is essentially a combination of different products, all of which are part of a bank's funding structure. Slide, please. So now let's look at the number crunching part of the process. And as I said, that's under the BISL or the Bloomberg Index Services umbrella. So after we collect that filtered data, we perform data and QC checks. And then we normalize the yields to make it a common yield construct, a money market construct. The next step in the curve fitting process, we'll give you a deeper dive into that methodology shortly, but we're just showing it to you from the higher level right here. So we take the trade weighted values of the transactions as well as the executable quotes. And then we trim out the outliers and we apply a localized linear regression to imply rates for each tenor. And upon generating the rates, we check the volumes that we use to produce each tenor to ensure we might meet a minimum threshold on each tenor. Now, I'm going to ask Bruno to comment on the concept of the localized regression.
Yeah, hi, thank you, David. Hello, everybody. Yeah, so the choice had to be made between collecting all the data and having a global fit through this big cloud of points, or to have something more localized, which is respecting the integrity of each one of the tenors.
Bruno, one second. Let me just ask the slide get moved ahead, please.
Okay. Yeah. Okay, so so essentially we start from a whole cloud of points, but we want to specify, to respect each of the tenors. If we look at, for instance, the 3 months tenor, so we have actually a maturity range of 75 days to 120 days. And so we first sort of specialize around this tenor to have a short maturity range, and we have to decide how to aggregate those values, which is essentially doing two things. One is to control for the outliers, and the second thing, it is to know how to aggregate. We tried many different combinations, and we take the volumes into account, and we make sure that the bank weights are not, that no bank is dominating the whole panel. And so eventually what we came up with, it was a method where we, in the logic, in the spirit of the Libor trimming, so we take away the 25 and 75% quantile. So we take away the top and bottom quartile, average the rest, but not a simple average, but a linear regression fit. And we take the value of this fit at the tenor. It's just to avoid a situation where you would have a steep yield curve, and in one of these maturity windows, most of the data would be on one side because it would bias. So in a nutshell, this is essentially what we are doing, and just why local rather than global is because global would force a global shape, which is not necessarily respecting the current situation. For instance, we have in December we had a hockey stick situation which was not capturable by a simple shape. So that's my point. You're muted, David.
Slide, please. Bruno, you might want to talk also about the concept of the linear regression and how we get the shape within the curve.
Yeah,
shape of the curve.
Yeah, sure. I can go into a few more details, just expanding on what I've said. So essentially, so we first want to make sure that no single transaction is dominating too much. So we capped the volumes at $500 million. And so we have an algorithm that we iterate to make sure that a bank contribution, the weight of a bank is not exceeding 20%. If it does, we redistribute the weight over the other banks. If it causes it to have other banks exceeding 20%, we repeat the operation until the condition is met. So to handle the outliers, so we tried many things like fancy quantile regressions, but every time we could compare two methods and having pretty much the same results, we are going for the simplest one, which is easier to communicate. And in this case, it's going back to familiar territory, which is the trimming at 25 and 75% quantiles, taking the volumes into account. So once we've done that, so we have this kind of box containing different transactions, so either executed or executable, and we perform the aggregation of those points with this linear fit. So this is this yellow dotted line, so a linear fit respecting the weights given by the volumes, and we keep from this regression the value at the tenor level. Here it's an example with 6 months, 180 days, and you have this orange cross in the middle, which gives us the index value for that tenor. Yeah.
Thank you, Bruno.
Welcome.
So I think this covers the representative part. We've talked about what the products are that we're using, commercial paper, CD, deposits coming from our platforms, the transactions that are coming across the Bloomberg, plus the corporate bonds, ultimately the curve fitting methodology. So slide, please. Now let's move on to the next building block that we identified, and that's robustness. So this graph shows the Bisbee average daily volume, 1 day volume, and its composition by product over the last 3 years. And the average daily volume of executed trades is approximately 55 billion per day. And if we add the executable quotes on there, we're in excess of 70 billion. Now, it's interesting to note from this graph that the volumes during COVID, which is March and April, you look at the scale down below, Bloomberg actually experienced real transactions and executable quotes that were posted on our platforms during this period of stress. And that's contrary to some of the news and some of the reporting that went on that indicated that there was no transactions taking place there at all. So slide, please. So now this is the slide that everybody wants. They want to know what's your volume per tenor. And this shows the breakdown. Here we can see the average daily volumes per tenor, the combination of executed and executable transactions. If you look at the one in the upper left, the overnight, you're looking at, on average, about 34 billion a day. If you move out to the 1 month, which is up on the top right, you're looking at about 9 billion, just under 10 billion in terms of daily average transactions. Lower left-hand corner, we're looking at 3 months, and your volume there is just slightly over 5 billion per day. And the 6 month tenor looks like it's just over 2 billion a day. Now, this is a 1 day transaction. So I think shortly we'll be publishing, shortly we'll be publishing a white paper where you'll actually see a full breakdown of our volumes per tenor. We show you the mins, the maxes, the medians, and the averages across all the tenors. And we've been asked to also point out when those occurred, the mins, the max, and that will be added as well.
Hey, Dave?
Yes.
Do you have information on trade count? It seems like that's something a lot of folks ask us on.
We do. So with respect to the median trade count, over all tenors, we have daily about 800 count transactions. At the 3 month area, the daily median is 220. The 6 month is 200. And even out to 1 year, we have over 200 calculations. So it totals about 800 per day. Next slide, please. Next slide.
Yep, it's there.
Oh, I'm sorry. There you go. All right, so this slide, as I said earlier, we conducted some hypothetical scenarios to ascertain the integrity, really, of our methodology and to see if it was susceptible to any manipulation. So we randomly adjusted any two contributors' executable rates across a spectrum of rate changes to see what that impact might be on the shifts to Bisbee. So we looked at shifts from up 20 to down 20 in 5 basis point increments. So what you can see here is that horizon of changes and how they translate to Bisbee changes. If you look on the left-hand side, that's downshift by 20, which is the most extreme. And there you saw less than 1 basis point, 0.85 basis point change on those rates. On the right-hand side, an up 20 shift actually translated to less than 1/3 of a basis point. So we feel that Bisbee has proved resistant to manipulation, at least during our testing. Slide, please. So now we've talked about representativeness. We've talked about robustness. Now let's talk about responsiveness. So here is a look back or a comparison of 1 month Bisbee to 1 month Libor going back just under 3 years. Here you see there's a strong correlation between Bisbee and Libor. And in the shaded area, that's the COVID time frame. And you'll notice Bisbee is the blue line and Libor is the black dotted line. Bisbee is actually proved to be more responsive, a leading indicator in terms of changes of funding rates and borrowing and lending rates during that period of time. Next slide. Here you see the 3-month correlation. And 3-month, again, very highly correlated with 3-month Libor. And if we look at the shaded area again, although it's not, if we blew this up, you would see that Bisbee actually turns up before Libor does, as well as turning down during COVID. But we feel like, again, it's a little bit more of a leading indicator. Now, one question that comes up all the time is, why is Bisbee below Libor? And the reason that is because the credit rating, the average credit rating of the 30 banks is lower than the 16 banks. Now, the 16 panel banks are equally weighted in terms of the calculation for the average weighting. With respect to Bisbee, it's weighted by contribution and by the values that each contributor brings in. So essentially, we have a slightly higher rating, which translates to a lower yield across the curve. In fact, on average, over the 3-year period, the 3-month has been about 6 basis points lower than Libor consistently. Next slide. So we've covered representativeness, we've covered robustness, we've covered responsiveness, and now resilience. So what happens to Bisbee on days when the volume is not as robust as it might ordinarily be? So we have what we call fallback logic, and we have thresholds set for each tenor. And when we go through the calculation process, after we calculate each rate, we check to make sure that it's been based on a volume for each tenor that meets a threshold level. If it's below that threshold, we have a 2-step process which we use. The first step is to widen those corridors that Bruno talked about. So here you see a chart that shows the standard windows. So for example, the standard window for 3-month is 75 to 110 days. And as Bruno pointed out, we don't use the data that's outside those corridors unless we have to use the first level of fallback. And in that case, we widen from 75, 110 to 46, 125 and use that data and go back and recalculate. And once again, after we calculate, we check the volume to make sure that we're over that threshold, in which case, if we are, they will proceed to publish to our tickers. And if not, there's a second step. And that second step goes back to the beginning and actually uses another list of banks, a broader list of banks that are also A1, P1, similar quality to the 30 banks that we're using up front. And we gather transactions from them. And in that case, we then use that data to calculate the transaction. And we should be over the threshold at that point, in which case then we publish to our tickers. So now, Monica, if you move to the last slide, I'll give you some practical information with respect to Bisbee. Number one, we're already publishing Bisbee on the terminal. It's available on the Bloomberg every day at 8 o'clock in the morning. except on and it's published on non-holiday U.S. business days. It represents the previous day's data. It's available on the Bloomberg and backfilled to December of 2017. So anything you can do with a normal index, you can load this, use the tickers which you see here, Bisbee ON, Bisbee 1M, BSBY 3M, BSBY 6M, or BSBY 12M, followed by the index key. You can see the description page. You can graph it. You can graph it relative to Libor. You can look at it historically. And it will also be displayed on BTMM, which is a very popular money market function. I believe it's actually there today. And it's on USSW. We're also about to release a function, which would be known as BSOF Go, which will chart the 3-month Bisbee, and below that we'll subtract out the SOFR term swap rate, the 3-month term swap rate, so you can actually see what the credit spread is right now against 3-month SOFR term. Now, next steps. Well, we get the question, is Bisbee going to be a standalone or a spread index? And certainly we intend to publish this as a spread when we have term SOFR rates. Right now you can look at BSOF to see the spread against the swap rate, but when we have term, we will publish this as a spread index. But right now it's an all-in spread, or it's an all-in yield, excuse me. Other things that we're considering, because as we said, this is published on the Bloomberg as an indicative rate, and we are beginning to socialize our methodology and socialize that rate with people. And so we're willing to listen to suggestions with respect to making it more robust and stronger. And some of the things that we've heard have included possibly using non-financial corporation CP transactions, which would help pump up the volume, I guess. The other thing that's been suggested is potentially using a rollback window to aggregate transaction data. It might smooth that curve a little bit more and provide resilience. Remember, the numbers that I told you about earlier are based on one-day transactions across the platform. I think if we looked at using a fallback, it would be even more robust in terms of those transactions. So I'm going to leave it here at this point. What I will say is we're open to any questions, but I'll also say we're happy to talk with everyone. As I said, there's a white paper that's be published to everyone tomorrow. If you want to contact us, we're happy to get it out. We're happy to do an individual presentation or to listen to suggestions that you might have. Please contact us, and if you have any questions right now, shoot them in.
Great. Well, thank you so much, David and team. We really appreciate the presentation. Are there any questions for the Bloomberg team? Okay, hearing none. Sorry, was there a question?
Nate, I had one question. Thank you guys for the presentation. I'm sure this is probably going to be in the white paper, but I was just curious, given that you look at certain market segments to arrive at a particular rate on the term structure, one, do you ensure that overall the curve follows risk-neutral guidelines for curve construction? And two, lots of analysis necessitate the use of stochastic analysis. Would there be a way to infer the volatility parameters that would allow us to do these exercises?
Bruno, do you want to take that one?
Mm-hmm. Yeah, so, sorry. Yeah. So clearly something which is very important is to make sure that our construction is not producing things that wiggle too much, for instance. So we have quite a few statistical quantities here to verify that we are doing a good job. For instance, we compare the volatility of Libor and the volatility of Bisbee. We also measure the autocorrelation because a typical problem with a bad construction would be that there are adverse movements from returns from one day to the next one. So we are following all those kind of guidelines here to check that the different choices that we contemplated are qualified, and within them we picked actually the simplest possible ones. Just to give you an example, we compared winterizing with just trimming. Winterizing means not eliminating the upper and bottom quartiles, but actually to floor them and to cap them to make them closer to the trimming band. We see that it's not really affecting the result much, and it's giving the same kind of statistics. So within the range of all those methods that are totally admissible in terms of this criteria, we picked the simplest ones. Is it what you wanted to know?
Yes, thank you.
Welcome.
Okay, well, I think we're at time for the Bloomberg team. Thank you very much for the presentation. Let's turn it over to Richard Sandor from AFX. Richard, if you're there, we can't hear you just yet.
Does that work, Nate? Can you hear?
Hear you loud and clear. Thank you.
Okay. Thank you, Nate. Thank you to the New York Fed for making this time available to us. We appreciate it and think this is of enormous value to the banks and to the index providers, et cetera, to tell their own story and hear their fellow providers tell their story. I'm here with Chris Giancarlo, who is a board member and colleague at AFX. Excuse me, and he will, at times, Chris is the former chairman of the CFTC or chairman emeritus, and may come in from time to time. I enjoyed all of the presentations, and I thought that they were terrific, and they reflect a fundamental view that we have, and that is there should be a free market for ideas, and this process may produce multiple index, and that would be good, much like the equity markets have S&P, Value Line, NASDAQ, a small cap, more ETFs in their equities. We hope that the index market, interest rate benchmarks, involve choice. So we have a different approach than most did. If you take a look at the history of financial innovation and go from the Dutch East India Company to carbon trading or Ginnie Mae's Treasury futures. Of these, I've been involved in a lot of them personally as a primary researcher. This was not including the Osaka Rice Exchange. I wasn't there, but I was there from the Ginnie Mae's to Maribor. Let me share with you, because it's not data, it's institution building on how we did. All of these involve starting a cash market, developing homogeneous standards, building up the integrity of the cash market by rules and regulations and governances, and then moving on to developing standardized contracts called futures, and then, in fact, non-standardized, let's call them over-the-counter derivatives. So let's take a quick look at AFX and the genesis of it. We decided to pursue this in a we decided to pursue this in 2011 after reading that the Royal Bank of Scotland fired 4 traders for manipulating Libor, and filed a patent in August of 2012 and wrote a paper for the World Financial Exchange annual meetings in Taiwan in September 2012. Hoping for and listening to my fellow presenters, we have a series of interest rate benchmarks, all of which are transaction-based. We took the Chick-fil-A or the Walmart strategy. We decided to visit 125 banks all over the United States. In 2015, we hired E&Y and Sullivan and Cromwell. We briefed all of the appropriate regulators with no asks and no criticisms, and we launched on 2015. Next, please. We saw a lot of flaws in the old way of doing business, and we felt that the audience that we were trying to address would be U.S. banks. We wanted to be self-regulated, we wanted to be transparent, and we wanted to be 100% transaction-based and IOSCO compliant from the outset. That was the objective. It was to be exactly what other benchmarks were not, and that was the motivation. Next, please. We noticed that as all of you well know, that the U.S. is a series of regional economies and that interest rates vary all over the country. So it was essentially important to try to get as many participants as we could from every part of the U.S. Thereby, we would have a natural balance to have regions where loan growth was high, coupled with regions where loan growth was low, but deposit growth was high. And therefore, you would do essentially what happened in the 60s and 70s with Ginnie Mae's, create a homogeneous national rate that wasn't regionally dependent and that would therefore be naturally less volatile. Our objective was to build the most boring interest rate in the world. It was to have no drama, no surprises, and be very customer friendly. So we achieved that goal, and if you could please move on with the slides. The idea was to build a rule book, and this was very important. Our approach was that we could control and build an anti-manipulation if we had a rule book that people who joined the exchange were legally committed to obeying the rules and regulations of the exchange. The rule book's 130 pages. It has anti-competitive behavior, it has governance, it has a board of directors which are independent, including the Honorable Chris Giancarlo, members from the private sector who are not part of the exchange. And we partnered with SIBO Global Markets. They are the hosts, they run, and most importantly, they operate under a franchise to do compliance and market surveillance. And for the futures, we use their futures exchange. So we have a cash market, an institutional rule book, oversight, and member committees. If we can move on, please. Whoever is keeping up with it, thank you. Okay, very important is the rules and committee structure, and we have business conduct committees, and and we have oversight for the benchmark. These are all mutually determined. It is not the exchange and its economists that are developing it. It is done as movies. It's a collaborative art between econometrics, sociology, economics, psychology, etc. And we have a membership committee, etc. Very importantly here, from the very outset, with the birth of algo trading and with electronic market making, what scared us most was spoofing. It is not necessarily the transactions that occur that will manipulate a market. It is very often those that never occur. And people are committing that. So we have specific rules about spoofing. We watch it carefully. Later on, we will tell you that every transaction occurs on a Ethereum. It's not a Bitcoin to be sold or bought. It's for compliance because it hits the complete underlying bids and offers. So we see the complete order book associated. So if somebody is spoofing, we can look at the order book for every single trade and see what's above the market, what's beyond the market, see if anybody's moved things close to the offer side or bid it up to the bid side. So we watch for spoofing as much as anything else. Please move on.
Could I just ask everybody to be on mute? I think there might be somebody who's off mute. Thank you.
Thank you. Next slide. It's very important when you invent a financial product to look at price mechanism. Darryl will understand in the formal field of economics, price mechanism design is a special field. And let me just quickly hit the highlights of what they are. So because of the regional variation in rates, we hope to have a national program. We also borrowed from our experience in the designing the Treasury contract and to make credit built in. So this is a bilateral market. There are filters with regard to counterparty, rate, and quantity. So we get away from the vertical model where smaller get credit from intermediate, who gets credit from larger. We have a peer-to-peer fintech. So a bank that has 7 billion may get as big a line, but more preferable from somebody within its size range rather than somebody who is much bigger to them that has to take on that risk or may not know them. So a central part of this is the lender driven. So every transaction really can adjust for whether a lender wants the counterparty or doesn't, what rate they'd lend to that specific counterparty or not, and the size of the line that they give it into. So credit sensitivity is based into it, and it's very, very important. There's a transparent central order book. So at every moment of the day, you can see there's, 5 billion above of offers, 3 billion below, and much like the Bisbee, which I was good to see, it's not for us to say, but people are interested in the data because we seem to get supply burdens of anticipation of lower rates and vice versa in anticipation of higher rates. We use the CBOE as a third-party service provider to perform market surveillance, regulatory compliance. They watch it, they have their own compliance things, so this is outsourced. If in fact there is an infraction or the perception of an infraction, they can report it to us at AFX. We can give it to a member committee on business conduct, And by the rules of the exchange, the banks are bound by peer review. They can put fines on, we can expel members, we have control of behavior, and we believe that is a very important function that organized exchanges perform. Let me go on, please. Who's ever operating the slides? Okay. So
Sorry, there's just a slight delay between when I hit go and it takes a few seconds to hit through.
I'll try to paste the remarks that way. Okay, we started out with 10 members, 8.8 million a day. We're doing about 2 billion a day. The data's a little behind. We're up to 208 members. The combined, we have 164 banks, about 45 to 50% of all banks between 5 billion and 250 billion. And they are in all 50 states. One of the things that you worry about when you design price mechanisms is not only the existing supply, and you worry about potential supply. So it goes back to deliverable grain in an elevator, to designing a treasury futures which is not current coupon, because you want to bring in on some formulaic basis off-the-run bonds as well as on-the-run bonds. So what we have done, when we started, we had 4 credit lines. And we're as conscious of building daily volume as membership as potential supply. So we went from very small lines, $50 million, and 4 lines, and not 50, somewhere I think less than 100. We now have 1,675, almost 1,700 bilateral lines, which have created 65 billion of potential deliverable supply. This is available capacity that would come into playing at the right rate, and we're very conscious of building that. We are also conscious, and we will announce in the not too distant future the addition of banks which may have $1 trillion, $1.5 trillion assets by the end of the year. So we will have 5 trillion. Right now it's 4 trillion in member assets, roughly 20%, 18% of all U.S. assets. And by counts, we have 164 banks and 1,000 correspondents. So we're roughly 20 to 25% of the U.S. banks have access to the market. Next, please. So AFX facilitates the calculation of Ameribor. The exchange has 2 purposes. One, to provide peer-to-peer overnight liquidity, collateralized, and sometimes 30-day, which trades intermittently. The rate to date has been very stable. It's got a 99.74% correlation. It does adhere to IOSCO. It has been independently determined. It is got a credit spread because it's unsecured, and it's also implicitly built in because of the 3 filters. Each bank figures out who it wants to lend to, what price, and what quantity. So if each loan has got a credit sensitivity, and the Ameribor is the weighted average of all of those loans. It is used because of the optimization of assets and liabilities. We list the 1-week, 30-day, and 90-day, and we began futures in 19. Next, please. There's been adoption. It is non-banks are in, insurance, broker-dealers, asset management. People are using it like Frost Bank for commercial loans. We had a meeting this morning, 100 banks, to go over the case studies of each bank and how it used. So Ameribor is being used to price commercial loans, floating rate deposit, and most recently, a month ago, a $375 million subordinated debt by signature, where the floating part was Ameribor and the backup rate is SOFR. And there are some interest rate swaps will occur in the next week or two. Next, please. If you take a look at Ameribor since its inception, it has the lowest volatility of any benchmark. It's lower by design. This is not an accident, okay, than overnight Libor, Fed effective, or SOFR. So it stands alone. If you will take a look at it, like the Bloomberg, it trades differently than Libor. We are a risk rate. So traditionally, we are higher than overnight Libor. Some banks may not like that, but from a risk management point of view, if it reflects their funding costs, then so be it that they are pricing it and then adding a credit spread to the borrowers. Next, please. I'm getting to the end, so we have a futures curve, as does the CME and as does ICE with Sonia, etc. We have developed a 30-day forward-looking term rate, and that forward-looking term rate is based upon Ameribor as well as primary issuance of CDs and commercial paper for a non-bank holding company. We will roll that out in the next 60 to 90 days. And we, as you can see here, that 30-day contract, because of the nature of our participants, will generally trade at an interest rate spread over Libor. It can be used outright. Next slide, please. It can be used as a spread. This is the forward-looking rate minus overnight Libor when the terms over SOFR, when term SOFR comes, we'll have it as a spread as well. So we are, because of the nature of our banks, they want to use this as a rate which they use themselves to price, or we want to make sure that it's available as a spread. Next, please. There's a widespread distribution. It's obviously on Bloomberg, which we're proud to have it on. It's available on CNBC and comes across on their tape. And next slide, please. It's also available to 17 separate index providers. And we have deals with MSCI, S&P, Thomson Reuters, et cetera, for information distribution. Next, please, Monica. Let me conclude by saying we have a special effort, and I'm going to ask for anybody who's interested in helping on this. 3 years ago, we thought that we would make a special effort to make our membership both diverse in gender and diverse in minorities. And we signed up the Bank of First Bank of Puerto Rico, then Hispanic banks, then African American banks, Chinese American, Korean American, and Native American banks. We formed a minority lending coalition. Some of you were on. I'm going to shamelessly say you're free to join and not join the exchange. and we're developing a platform because minority banks need loan participations. And so we're going to basically come up with some indices and something which is specifically devoted to the minority community. What have we said? We built it from the bottom up. It's rules-based. It is, by the way it's built, has many available tools for compliance, and we will be publishing a complete term structure up to a year. Past that, we'll leave it to IHS Markit, to Daryl, to other people to develop a term structure further out. Thank you very much. I'm sorry for the delay in time, but I think we made it within 3 minutes.
You did indeed, Professor Sander. Thank you so much, Dr. Sander, and both you and Chris for coming on and doing this presentation. Let us open it up for a few questions. We have just a couple more minutes actually on your clock, so let's see if there are any questions for the AFX team.
Nate, if there are no questions, perhaps I can just add something in. I know Richard well presented the fact that what makes Ameribor unique is it's based upon a real marketplace of American banks and commercial credit lenders, insurance companies, and private institutional investors. And they use the marketplace to finance lending to the real economy of home builders, auto lenders, and small to medium-sized manufacturers, lenders who have real credit risk to commercial collateral-based lending to the U.S. economy. And they're passionate about the marketplace because it provides them with direct access to short-term lending by other similarly sized and situated financial institutions in other regions of the country. And it's an alternative funding source to the large money center banks. And it assures its members that their funding is competitively priced and sourced. And the benchmark that's derived from this real marketplace is the result of unsecured counterparty credit risk analysis by bank credit officers of banks and financial institutions in all 50 states. And that makes the benchmark democratic, transaction-based, and transparent. And it's also organic. It's not derived from anything other than its own members' commercial financing activities. And it's growing, and it's continuing to grow steadily. And that's because American lenders want choice and competition in their funding and lending operations, and quite frankly, in their choice of benchmark. I hope that's helpful just as an overview.
Chris, let me amend that because you opened up a good point that I didn't. That I have the ultimate respect for the quantitative world. Nate, we're trained similarly. I took real analysis and a little bit of combinatory topology and certainly econometrics and blah, blah, blah. But there's nothing like marching a guy from the hills of Kentucky to Queens to look at a bank's portfolio of taxi medallions to understand credit risk. And to build those bridges, the highest forms of mathematics don't necessarily substitute. So we're in the business of really building credit at the qualitative level, not only the quantitative level. And that credit analysis gets lost in looking at the macroeconomic data. And the fact that 1,700 separate decisions have been made is very important for the integrity of the market and the credit spread.
Thanks for the additional information there. I really appreciate that. Are there any questions for Richard or Chris? So let me open up the line for any questions for any of the presenters now. If you do have a question specific to a presenter, you could ask that at this time, or a question that we could offer up to any of the presenters. Happy to do that as well, since we have just a few extra minutes. Okay, I'm not hearing any questions, so I want to give a special thanks to all of today's presenters. We really appreciate hearing from market, from Professors Duffy and Berendt, from IBA, Bloomberg, and AFX. Thank you all so much for coming and presenting to this group and for the good dialogue today. We will give you a few minutes of your day back, and we look forward to speaking to you all again. Have a great afternoon.
Thank you very much.
Thank you, Nate and team.
Thank you.
Great.